Bitcoin is not moving alone. This is not just another crypto liquidity story. Oil is moving, inflation is back in focus, and yields are shaping risk appetite again. The real question is not only what Bitcoin is doing, but what the macro pressure map is telling us. Welcome to the Calm Metrics. This video is not financial advice, and it is not a trading signal. It is a calm market brief designed to explain what may be happening behind the price. Today, Bitcoin is being tested by oil, inflation, yields, liquidity, and investor behavior at the same time. When Bitcoin moves sharply, many traders look only at the Bitcoin chart. But markets are connected. Crypto does not live in a separate world. When macro pressure rises, Bitcoin can become one of the fastest places where risk sentiment shows up. That is why today's video is different from a normal crypto update. We are not only asking whether Bitcoin is bullish or bearish, we are asking whether the wider market is becoming more defensive. And that starts with oil, inflation, yields, and the dollar. The first layer is Bitcoin structure. Price still matters because it shows whether buyers are defending important levels. If Bitcoin stabilizes, the market may still have a foundation. But if structure keeps weakening while macro pressure rises, the setup becomes more fragile. A single bounce does not prove strength, and a single red candle does not prove collapse. The Calm Metrics does not read one candle in isolation. We read the pressure behind the move. That pressure can come from crypto, but it can also come from the wider market. The second layer is oil. Oil matters because energy prices feed directly into inflation expectations. When oil becomes volatile, investors start asking whether inflation could stay higher for longer. And when inflation looks sticky, markets become more careful with risk. This is why oil is not just an energy story. It can become a market liquidity story. If oil rises sharply, investors may worry about inflation and higher for longer rates. If oil falls after geopolitical headlines, markets may still remain cautious because volatility itself changes confidence. The key point is not whether oil is bullish or bearish today. The key point is what oil does to inflation expectations. If energy prices stay unstable, markets may price in more uncertainty, and uncertainty usually makes investors more careful with risk. The third layer is inflation. Inflation data matters because it shapes expectations for the Federal Reserve, Treasury yields, and liquidity. If inflation cools, markets may become more comfortable with risk. If inflation stays sticky, investors usually demand stronger evidence before chasing risk assets. That matters for Bitcoin. Bitcoin can move on its own narrative for short periods, but when inflation pressure is still alive, liquidity becomes more important. The market needs more than excitement. It needs capital, confidence, and confirmation. The fourth layer is Treasury yields. Yields are one of the clearest signals of how expensive risk can become. When yields stay high, safer assets become more attractive. That can make investors more selective with stocks, crypto, and other risk assets. This does not mean Bitcoin must fall every time yields rise. Markets are never that simple. But high yields can raise the bar for risk-taking. And when the bar rises, weak liquidity becomes easier to expose. This is why yields are important for crypto investors. They do not need to explain every Bitcoin candle, but they help explain the background pressure behind risk assets. When yields stay elevated, liquidity-sensitive assets usually need stronger support. The fifth layer is the dollar. A stronger dollar can make global liquidity conditions feel tighter. It can pressure risk assets because capital becomes more defensive. Bitcoin is global, but it still reacts to liquidity conditions. If the dollar stays firm while yields remain elevated, crypto rallies may need stronger confirmation. If the dollar weakens and risk appetite improves, Bitcoin may get more room to recover. The direction is not guaranteed, but the background becomes easier or harder depending on those conditions. That is why the dollar matters inside a Bitcoin brief. It tells us something about global risk appetite. A Bitcoin chart may show the local move, but the dollar can show whether the wider liquidity background is helping or resisting that move. The sixth layer is equities and risk appetite. Sometimes stocks hold up while crypto weakens. Sometimes both move together. But when investors become defensive, Bitcoin often reacts quickly because crypto is one of the most sensitive risk assets. If the S&P 500 or Nasdaq remains strong, risk appetite may not be broken. But if equities weaken while Bitcoin is already under pressure, the signal becomes more serious. A calm investor does not ask only what Bitcoin is doing. A calm investor asks whether the whole risk environment is changing. That is why we watch stocks as part of the pressure map. They help us understand whether risk appetite is holding, fading, or becoming more selective. The seventh layer is Bitcoin ETF flows. ETF flows help us read institutional demand. When ETF inflows are strong, they can support confidence. When flows weaken or turn negative, one layer of demand may fade. ETF flows are not the entire market. They do not guarantee that Bitcoin must rise or fall, but they are useful because they show whether larger buyers are adding support. If Bitcoin is weak and ETF demand is also weak, the market needs help from other layers. The eighth layer is stablecoin liquidity. Stablecoins are like dry powder inside crypto. They represent capital that may already be close to the market. If stablecoin supply is healthy, the market may still have fuel. If stablecoin liquidity weakens, rallies can become more fragile. This is where the macro story connects back to crypto. Oil and inflation affect expectations. Yields and the dollar affect liquidity. ETF flows show demand, while stablecoins show whether crypto still has fuel inside the system. Together, they help answer a deeper question. Is the market supported by real capital, or is it only reacting to short-term headlines? The ninth layer is positioning. Funding rates, open interest, and liquidation zones help us see where leverage is building. They do not predict the future, but they show where instability may appear if price moves quickly. If late longs are crowded, a sharp drop can force them out. If aggressive shorts become too confident, a bounce can squeeze them quickly. The point is not to guess which side wins. The point is to understand where pressure is concentrated. That is why positioning is a pressure map, not a trading signal. It helps us read where the market may become unstable. When leverage builds inside a fragile macro environment, small moves can become larger than traders expect. Now bring the full picture together. Bitcoin is not moving alone. Oil volatility affects inflation expectations. Inflation affects yields and Federal Reserve expectations. Yields and the dollar affect liquidity. Liquidity affects risk appetite, and risk appetite affects Bitcoin. That is the real story of this video. Bitcoin is not just reacting to one chart. It is being tested by a wider macro environment. That is why the title is not about one price level. The title is about the macro risk test. A stronger setup would show several things improving together, not just one fast bounce on the Bitcoin chart. A stronger setup would mean Bitcoin structure stabilizes, oil pressure cools, and inflation anxiety eases. It would also mean yields and the dollar stop pressuring risk appetite. ETF flows would become more supportive, and stablecoin liquidity would remain healthy. A weaker setup would look different. Bitcoin structure would remain fragile, oil volatility would keep inflation concerns alive, and yields or the dollar would stay firm. ETF flows would fail to support confidence, and crypto liquidity would become less convincing. This is the difference between a price update and a market brief. A price update tells us what moved. A market brief asks why the move may be happening. The calm metrics is focused on the second question. That is why the calm metrics does not read price alone. Price is visible, but it is only the surface. The deeper story is structure, macro pressure, liquidity, flows, positioning, and behavior. When those layers line up, the signal becomes stronger. So the key takeaway is simple. Bitcoin is not moving alone. Oil, inflation, yields, the dollar, ETF flows, and liquidity are part of the same pressure map. Stay calm, read the data, and respect the risk. That is the calm metrics way.